Welcome, everyone. I'm Angelo Robles at Family Office Association. Today is Tuesday, March 31st. The importance is it's the end of the quarter. A really devastating quarter for not just an investing perspective, for the obvious reasons globally of COVID-19. But the purpose of my video today is to give an update mainly from the perspective of our families on their investment portfolio and potentially opportunity moving forward. So the challenge we have now is a significant decline in the last couple of weeks of the equity markets, and to some degree real estate and certainly bonds as well. So everything, I guess, except for gold and certain commodities, has been impacted. You can look at it as we're in it for the long term, not for the next 1 day, 1 week, 1 month. And looking at it as, let's look at the financials of a company. Let's take a look at looking at the future. Is this the type of sector that's going to be impacted by the changes we're going through now? Our workforce is going to become more remote. Will virtual reality start to take a greater step forward? And could there be changes? There's always changes. Companies that were in the S&P 500 10, 20, especially 25, 30 years ago, many of them are no longer there. So it's no assurance that just hanging on to a specific stock, even if it looks like a good deal now, is going to be sustainable over many, many decades. Things appear to be exponentially changing around the world so quickly. It's very, very hard, and no one could really have a crystal ball and know what's going to happen in the future. In general, for the masses, sure, we know you're young, you have time on your side, invest more in equities. And in real estate, it's always going up in blocks of a decade or longer looking out. It's no guarantee that's going to happen potentially moving forward. But again, you got time on your side. Families already have the wealth and resources. Do they want more? Well, sure. And oftentimes to be able to build their legacy and to put their philanthropic dollars to good use and to work, so benefiting society as well. But in general, as I've said so many times, you're probably getting tired of me saying it, a family wants to stay, let's say, rich in resources, and money, capital, is one of those resources. So hedging their risk becomes incredibly important. You would think that diversity would help to hedge risk. In most cases, it does. It may dampen returns because you have a little bit of too much diversity, but again, hedging risk is going to be incredibly important. But this decline creates a tactical opportunity. Yes, we understand long-term strategic is generally the way to go, but there are times we believe, and our families believe, that you need to be tactical. You need to look at the situation, say there's some good companies there with good prospects moving forward, and their price is simply it's declined. Now is a good buying opportunity looking at it from a long-term perspective. There are families we know that are actively buying real estate. Now, again, at a decline, using Google Earth to look at the property, having local resources on the ground, legal and real estate and otherwise, to do more of the site inspection, and looking at it simply as a mathematical perspective. But as I noted, there are certain experts and resources that we have that believe that we could be in for a really challenging recession that could last for a long, long time, potentially 10 years. And again, hedging risk is going to be a very important aspect for families. Where family offices potentially have the advantage is they're small and nimble. They don't have the bureaucracy of larger organizations, and a family could be more Machiavellian, more entrepreneurial, and potentially, if they want, take more aggressive risk. They don't have to answer to shareholders and others that may want to see shorter-term profitability. So in theory, you would think that family offices have an advantage in times like this. That also depends on the quality of their staff, the motivation of the staff, the compensation, how that all plays in, and all of that is so dynamic and changing. Really, as I'm shooting this video, it seems like there's new dynamics in that with families every day. But this is an opportunity for those that are more active as investors in the family office to potentially take advantage of the opportunity of depressed values in various assets, public equities, bonds, real estate, and private companies, which again have the illiquidity challenge, but potentially, because of more inefficient markets, offer the opportunity for greater return. And many single family offices are going to look across all those assets relative to opportunities, both perhaps short term, but certainly longer term, 3 to 5 years moving forward. Again, the advantage of the SFO is it could be nimble during challenging times like this. You look at the word hedge and hedge fund managers, and for the most part, they've not lived up great to the term hedging in a hedge fund portfolio. But the markets that we're going through now will allow some that are more talented in shorting or leveraging and concentrating opportunities to be able to take advantage. So this could be a good time. There's alpha skill in choosing managers as well. It doesn't all have to be strictly internal. There's a talent and a skill known as alpha, above an average or a beta return, even in choosing best of breed managers, of course, needing to factor in taxes and fees as well. You know, things are changing. The COVID-19 will have lasting impact, especially as it goes on longer and longer in something like real estate. The Amazon effect, where malls and certain traditional department stores that are laying off employees in masses at the moment, you know, will they really ever bounce back, or is now a great buying opportunity? Or will the advent of real VR that actually works really good create an opportunity for more remote teams, buying, purchasing of retail? So all of that could be impactful to real estate. Dynamics could change from residential real estate to even online universities and colleges, or more traditional universities offering online programs. So there's lots of dynamics that we don't know. And then we have the advent of AI and robotics and manufacturing being more replaced by that over time, driverless cars. We all know some of that negative story, or the perception of it, that could happen. If this was easy, we'd, all be doing it. I've also spoken in the past, and not really the subject of today, about diversity of custodians and about investments in general for hedging a portfolio, including hedges like gold and certain other commodities, some getting crushed now, so certainly be very careful, and even something like cryptocurrencies. But in general, we're looking at families that are very concerned globally about what's going on, want to be a good citizen, a humanitarian, want to put their philanthropic dollars to work. This is an opportunity for the family and for the younger generations to truly make an impact. And we don't have the time, that's a different discussion, to go specifically into impact investing, which is absolutely on the rise with families, driven perhaps by the younger generation, but we're seeing more of the elders in the older generation buy into more of the humanitarian and society perspective as well. So in general, in giving a very short video relative to what we're hearing and what we're seeing, the perspective of our families and experts, that's a little bit of a brief overview in the market. Everyone, I'm Angelo Robles at Family Office Association.